Hey everyone, and welcome back to the channel. This is Trenksy, your guide towards successful living. Today, we're diving into a topic that might sound a little counterintuitive. Debt that can actually make you richer. Now, before you click away thinking this is some get-rich-quick scheme, hear me out. Not all debt is created equal. See, most people think about debt as a bad thing, and for good reason. Credit card debt with those crazy high interest rates? Yeah, that's definitely going to keep you stuck. But what if I told you there's a whole other side to debt? A side where you strategically use borrowed money to build wealth, not destroy it. That's what we're talking about today. Using good debt to acquire assets that put money in your pocket, not drain it. We're going to explore how you can leverage debt to invest in real estate, grow your business, and even boost your investment returns. So, buckle up, because we're about to unlock the power of good debt. Let's kick things off with a classic wealth-building strategy: rental property mortgages. Think about it. You secure a property with a mortgage, and then, here's the magic, your tenants essentially pay down that mortgage for you through their rent. It's like having someone else cover your housing costs while you build equity. But it gets even better. Historically, real estate tends to appreciate in value over time. So not only are your tenants covering your mortgage, but the value of your property is also potentially going up. That's a powerful combination. And let's not forget about the tax advantages. As a rental property owner, you can often deduct mortgage interest, property taxes, insurance, repairs, and even depreciation. This can significantly reduce your taxable income, putting more money back in your pocket. Of course, being a landlord isn't always a walk in the park. You'll need to manage the property, find tenants, and handle maintenance. But when done right, leveraging a mortgage for a rental property can be an incredibly powerful wealth-building tool. Next up, we have something a bit more advanced and definitely comes with a major disclaimer: margin loans for investing. Now, this strategy is not for beginners. It's like using a chainsaw instead of a handsaw. It can be incredibly effective, but only in the right hands. So what is a margin loan? It's essentially a loan from your brokerage firm that allows you to borrow money against the value of your existing stock portfolio. The interest rates can be surprisingly low, often in the range of 2 to 5%. The idea is to take that borrowed capital and reinvest it into potentially high-growth assets, aiming to amplify your returns. But here's the catch, and it's a big one. Margin loans amplify both your gains and your losses. If your investments don't perform as expected, you could end up owing more than you initially borrowed. That's why this strategy is generally for experienced investors who have a strong understanding of risk management and the assets they're investing in. Remember, do your thorough research and understand the risks involved before even considering this. Now let's talk about fueling your entrepreneurial dreams with SBA loans for business expansion. The Small Business Administration (SBA) offers government-backed loans with attractive low interest rates, specifically designed to help small businesses grow and scale. Imagine you've poured your heart and soul into building a successful local business. You've got a loyal customer base, a great team, and you're ready to take it to the next level. Maybe open a second location, expand your product line, or invest in new equipment. But traditional bank loans might be difficult to secure, especially for a growing business. That's where SBA loans come in. These loans often come with more favorable terms than traditional bank loans, making them a valuable resource for ambitious entrepreneurs. The increased revenue from your business expansion can then help you pay back the loan and ultimately increase your overall business value. It's like having a financial partner in your corner, helping you achieve your entrepreneurial vision. Next up, we have HELOCs, or home equity lines of credit for investments. Now, before you start thinking about using this to buy a fancy car or go on a shopping spree, let's be clear. We're talking about using HELOCs strategically to build wealth. If you own a home and have built up equity, a HELOC allows you to borrow against that equity. The interest rates on HELOCs are typically lower than credit cards or personal loans, making them an attractive option for accessing capital. One smart approach is to use a HELOC to fund home renovations that increase your property value. This is essentially using debt to create a more valuable asset. Think kitchen upgrades, bathroom remodels, or even adding a rental unit. Another powerful use is to invest in other cash-flowing assets like another small rental property or even funding a side hustle. Just remember, your home is on the line with a HELOC, so it's crucial to have a solid plan for repayment and ensure your investments are likely to generate a positive return. Let's explore the world of peer-to-peer (P2P) lending for side hustles. P2P lending platforms connect borrowers directly with individual investors, cutting out the traditional banks. This can be a great option for funding a side hustle or small business venture, especially if you don't qualify for traditional loans or want more flexible terms. You can often secure loans at interest rates ranging from 6 to 10%, which might be higher than some other options but can still be worthwhile for funding a potentially profitable side business. Imagine you want to start an e-commerce store, launch a dropshipping business, or expand your freelancing services, but need some initial capital for inventory, marketing, or equipment. If your projected return on investment from that side hustle is significantly higher than the 6 to 10% interest rate, then this borrowed money can be a powerful catalyst for growth and ultimately increase your income. The key here is to have a well-thought-out business plan and a clear path to profitability. Remember, this isn't free money, it's an investment, and you need to treat it as such. Now for something that requires more expertise and risk tolerance. Land loans, if developing or flipping. This isn't about buying a plot of land to build your dream home. It's about strategically acquiring undervalued land with the intention of developing it, perhaps building houses or commercial spaces, or simply flipping it for a profit. Land loans can be more complex and often come with different terms than traditional mortgages. They often require larger down payments, shorter repayment terms, and potentially higher interest rates. However, if you have the knowledge, experience, and a solid plan, the potential returns can be substantial. You're essentially using borrowed money to create something of greater value. You're taking raw land, adding infrastructure or structures, and significantly increasing its market value. This strategy definitely isn't for the faint of heart and requires significant due diligence and market understanding. But for those willing to put in the work, land loans can be a powerful wealth-building tool. Finally, let's talk about franchise financing. Buying into a proven franchise like a McDonald's or a UPS store often requires a significant upfront investment. But instead of starting a business from scratch, you're buying into a system, a brand, and a support network that's already in place. Franchise financing typically involves securing loans to cover the initial franchise fee, equipment costs, inventory, and working capital. While you'll be paying interest on these loans, the established revenue streams of the franchise can make it a worthwhile investment that ultimately increases your wealth. The advantage of franchise financing is that you're not reinventing the wheel. You're buying into a business model with established systems, brand recognition, and often ongoing support. This can significantly lower the risk compared to launching an entirely new venture. Of course, thorough research and due diligence are still crucial. So, there you have it. 7 examples of how strategic debt can be a powerful tool for building wealth. The key takeaway here is that it's not about avoiding all debt, but about understanding the difference between good debt and bad debt. Good debt is used to acquire assets that have the potential to generate income, appreciate in value, or grow your business in a way that ultimately outweighs the cost of borrowing. Remember, always do your own thorough research, understand the risks involved, and ideally consult with a financial advisor before taking on any significant debt. This information is for educational purposes and should not be considered financial advice. What are your thoughts on good debt? Have you used any of these strategies? Let us know in the comments below. And if you found this video informative, please like and subscribe for more content on personal finance and wealth building. Thanks for watching, and we'll see you in the next video.